Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Equity compensation in multinational companies. Equity compensation serves as a critical component of the total reward strategy in multinational companies, providing a mechanism to align the interests of employees and shareholders while enhancing retention and motivation. Equity compensation typically includes stock options, restricted stock units, and performance shares, each with distinct characteristics and implications for both the employer and the employee. These forms of compensation are especially pertinent in the global context, where companies operate across diverse regulatory, cultural, and economic landscapes, adding layers of complexity to their implementation and management. Stock options grant employees the right to purchase company stock at a predetermined price, known as the exercise or strike price, after a certain period, known as the vesting period. The primary advantage of stock options is that they tie employees' financial gains directly to the company's performance, aligning their interests with those of shareholders. This form of compensation is particularly effective in high-growth industries where stock price appreciation is anticipated. However, the accounting treatment of stock options, governed by the Financial Accounting Standards Board's Accounting Standards Codification Topic 718, requires companies to recognize the fair value of options as an expense, impacting their financial statements. Restricted stock units differ from stock options in that they represent a promise to deliver shares of stock to employees at a future date, contingent upon the achievement of specific conditions, such as continued employment or performance goals. RSUs are typically valued at the market price of the stock on the grant date, and do not require employees to pay an exercise price, making them less risky compared to stock options. RSUs are advantageous in volatile markets or industries where stock price appreciation may be uncertain. Furthermore, RSUs are often subject to favorable tax treatment in many jurisdictions, enhancing their attractiveness as a compensation tool. Performance shares are another form of equity compensation that awards employees with stock based on the achievement of predefined performance metrics, such as revenue growth, earnings per share, or total shareholder return. These metrics are typically measured over a multi-year period, ensuring that the awards are closely tied to the long-term success of the company. Performance shares incentivize employees to focus on strategic objectives that drive sustainable growth, thereby benefiting both the company and its shareholders. The challenge with performance shares lies in setting appropriate performance targets that are both challenging and attainable, necessitating careful consideration of the company's business environment and competitive landscape. The implementation of equity compensation in a global context requires multinational companies to navigate a myriad of regulatory and tax considerations. Different countries have varying rules regarding the taxation of equity compensation, which can significantly impact its effectiveness as a motivational tool. For instance, in the United States, stock options are subject to different tax treatments depending on whether they are classified as incentive stock options or non-qualified stock options. ISOs may be eligible for favorable tax treatment if certain conditions are met, whereas NSOs are typically taxed as ordinary income upon exercise. In contrast, countries such as the United Kingdom and Canada have specific tax advantage plans for equity compensation, such as the Enterprise Management Incentive Scheme in the UK, which provides favorable tax treatment for qualifying stock options. These disparities necessitate a tailored approach to equity compensation in each jurisdiction, ensuring compliance with local regulations while optimizing the tax efficiency of the plans. Cultural differences also play a significant role in the design and perception of equity compensation. In some cultures, employees may value immediate cash compensation more highly than long-term equity awards, necessitating a balanced approach that incorporates both elements. Additionally, the communication of equity compensation plans must be carefully managed to ensure that employees understand the value and benefits of these awards. Effective communication strategies include providing clear and concise explanations, using visual aids to illustrate potential gains, and offering educational sessions to address any questions or concerns. Despite the complexities, the benefits of equity compensation in multinational companies are substantial. For example, companies like Microsoft and Google have successfully utilized equity compensation to attract and retain top talent, fostering a culture of ownership and innovation. These companies have demonstrated that well-designed equity compensation plans can drive employee engagement, enhance performance, and ultimately contribute to the company's long-term success. The key to achieving these outcomes lies in the careful design and implementation of equity compensation plans that align with the company's strategic objectives, regulatory requirements, and cultural context. In conclusion, equity compensation represents a powerful tool for multinational companies seeking to align employee interests with those of shareholders, enhance retention, and drive performance. The effective implementation of equity compensation requires a nuanced understanding of the various forms of awards, regulatory and tax considerations, and cultural differences. By leveraging the appropriate mix of stock options, RSUs, and performance shares, companies can create a compelling total reward strategy that supports their global business objectives. Ultimately, the success of equity compensation plans hinges on their alignment with the company's strategic goals, compliance with local regulations, and effective communication to employees, ensuring that they fully appreciate the value and benefits of these awards. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.